Hello and welcome to MC Explains, an investor education initiative brought to you by Moneycontrol and Invesco Mutual Fund. With equity markets in correction mode, investors are seeking the best way forward. There are apprehensions as portfolio values fall, and for those who started their equity investment journey in the last 6 months or so, returns are even negative. Losing capital so early in the journey can be very unnerving, and you're likely to start questioning the effectiveness of investing in an asset like equity. Not just that, there are many who feel that adding more money in such times can lead to further losses and hence are questioning the steady monthly systematic investments going into a mutual fund scheme. There are two things to unpack here: why are the markets correcting and what you should do about it. Let's address the first point. Why are the markets correcting? If you haven't been told or haven't yet experienced it, equity markets do not give you linear returns. It is always going to be up and down with stock prices. However, the last 9 calendar years have seen the benchmark Nifty 50 index deliver only positive returns, which means that many new investors are unused to seeing prices fall like this. And it also means that perhaps stock prices had moved ahead of fundamentals and needed to retrace. The immediate trigger, other than expensive valuations, is the uncertain global economic environment, geopolitical uncertainty, and the change in policies that can potentially disrupt global trade. All these factors together have prompted large institutional investors to rework their risk stance and sell out of volatile assets for the time being. This is not the first time that a correction has happened in the equity markets. We have seen such economic uncertainty and market cycles play out previously as well. In the short term, news, macro events, and demand and supply dynamics dictate equity prices. Over longer periods of time, however, it is the fundamentals of the underlying companies and their earnings growth expectation which matters the most. When our domestic equity markets corrected in 2007-2008, triggered by the subprime crisis in America, the fall in prices lasted roughly 14 months, and at its lowest, the benchmark index was down around 60%. However, today the benchmark index is up roughly slightly more than 3 times from that peak in January 2008. Long-term equity investing is about patience. If you have invested in good quality stocks or equity mutual funds, you need to remain invested across market cycles. Good quality companies are able to grow earnings for decades. And eventually, that is the trajectory of growth that the stock price also follows. The interim noise and the market movement needs to be assessed against your goals rather than the nervous emotion that they can cause. What should you do? The second part to unpack here is whether you need to sell, pause, or buy more in such periods of price correction. If you have just started investing, you will feel the pain more than others who are already sitting on accumulated gains from the last few years of investing. When the markets corrected just as COVID-19 was being declared a global pandemic, there was major panic. And within a few days, the benchmark index had lost almost 50% value. On a single day towards the end of March 2020, the index fell 12%. If you had sold your equity holdings or stopped your SIPs, you would have missed out on the upside that came in April 2020. Single day gains in April were very sharp, and from that point on, we saw the markets rallying for the next couple of years. Long-term investing requires you to not only remain invested, but also continue your regular investments through the months so that you can achieve those inflation-beating equity returns. If you stop or sell in between, you will not be able to fulfill that return expectation. At lower prices, you can buy the same good quality stock portfolio or mutual fund scheme at a lower price. Plus, remember that the monthly SIP itself is not a large proportion of your overall portfolio. A regular SIP is a way to invest in mutual funds, but it is also a way to save regularly. And if you stop, what will you do with that amount? Will you spend it? Where will you reinvest? The key to investing requires you to stick to an asset allocation plan. This needs to be built at the start itself. If you haven't done it yet, maybe you can consider it now. Your personal asset allocation will depend on your personal goals. Long-term goals which exceed 5 to 7 years till achievement will benefit with equity exposure as volatility smoothens over the long term. Short-term goals like emergency funds and immediate 6 to 12 month fund requirements can be invested in fixed income mutual funds. Anything in between can benefit from hybrid funds with a mix of equity and debt. In euphoric markets, where equity prices rise relentlessly, your allocation to the asset also goes up. That is the time to sell and realign your allocation. In markets which are correcting, your equity allocation may fall below the original mark. That's when you can invest more. Other than that, you do not need to tamper with your equity investment allocation, whether it is through SIPs or lump sum. This is the simplest way to approach market volatility. If the correction continues to unnerve you, keep in mind that equity markets ultimately track corporate earnings which are impacted by economic growth in an economy. India's economy, regardless of the speed breakers, continues to grow. 10-15-year SIP returns from the equity market benchmark are still in the average range of 10 to 12% annualized return. If you stick to the accurate goals and investment timelines, there is less need to panic and you will have a higher chance of achieving your goals. Hope this video has been useful in explaining what to do when markets are falling. Keep watching MC Explains for more such informative videos on mutual funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.